since January 6th in the Fed minutes release, we've seen one of the largest increases to interest rates since I don't even know when. What happened? Stay tuned. Hey, it's Rick Elmendorf here with LoanWithRick.com, powered by Movement Mortgage, where we give you the best tools and tips for managing your mortgage and winning that home you love. On this channel, we do a lot of strategy videos as well as market updates, real estate advice, things of that nature. So if you're new here, please consider subscribing. So really what happened, we had a Fed minutes were released on the 6th of January, and they basically went into a plethora of information that was not good for the mortgage markets. So let me just kind of give you an overview of what's happened since that date, which is this timeline here. Now, red is good and green, red is bad and green is good. Now, what really happened, the precipice of the, or the tenor of the meeting and the notes from the Fed were this. There is a 76% chance that interest rates will go up and they will be making monetary changes up in rates in March, as well as they've just recently released that they're going to probably jack rates at least 3 times. March, we don't even know if it's going to be 25 basis points or 50, but safe to say interest rates are going to go up. Now, if interest rates go up, actually mortgage bonds actually like that as news, but that's not really why interest rates are going up. The biggest reason is that the Federal Reserve is going to be taking a sideline on their purchasing of mortgage-backed securities. They're going to be shifting some of their reinvestment into treasuries, which is really to help to keep the payments on our immense amount of debt low. Unfortunately, buying mortgage-backed securities really doesn't give the Fed that benefit. The second reason is that interest rates are going to go up is that the Fed is going to be reducing their balance sheet. They currently have about an $8.8 trillion balance sheet. 8.3 of it is in treasuries and mortgage-backed securities. And so when they kind of look to shave off some of that $8.8 trillion, the fall guy is going to be mortgage-backed securities. So when that happens, I mean, it's just simple supply and demand. If the major buyer of mortgage-backed securities goes away, then interest rates are going to go up. So you're going to see this these little red thingies happen a lot more. And if you look back in time here, really going back even 2 years, you're going to see that interest rates are actually still, they've probably dipped down to the lowest they've been in 2 years. We've been living in literally fantasy land in interest rates for the past 2 years. I mentioned one time in one of my team meetings that we have lived in an artificially low interest rate environment. And this has fueled housing, this has fueled everything. I mean, when you put the cost of borrowing so cheap, then everything benefits, right? Now, we're gonna see a major turn here in the coming weeks here, months, as some of these interest rate changes and interest rates going up, it is going to affect housing. I don't see how it can't. Right now, we're in an absolute crazy seller's market. Buyers, there's no inventory, and that's due to many reasons out there, but you're gonna see an impact in housing, how much an impact rates is gonna have on housing, probably come the second or third quarter. I did want to mention a silver lining here with regards to interest rates. Interest rates, yes, they've gone up, but there is a huge spread now between the 30-year fixed rate and some of the shorter term money out there. Let me tell you what's available now. So like I said, we've had a tremendous increase in the 30-year fixed. We've seen almost a full % increase in rate. Yes, in rate. Now I'm not talking cost, in rate. What we have not seen is the same increase in shorter term rates. Short term rates, meaning even a 15-year is still lower. But what I'm really talking about is 30-year money, but on adjustable rate mortgages. Now, before anybody flames me in the comments, just let you know, I am not a huge fan of adjustable rate mortgages. However, they do have their place. So why would you get an adjustable rate mortgage? Why would you even look at one? Well, if your tenure in the house is going to be less than the term of your adjustable rate mortgage. So the way ARMs work is that your interest rate is fixed for a period of time and then it goes adjustable. So it doesn't start off adjusting. It actually is fixed for a period of time, 5, 7, or 10 years. The benefit to that is that because the bank doesn't have to lock you in for 30 years, they only have to lock you in for 5, 7, or 10, they give you a lower interest rate. And that's really good for a consumer. So right now, you can see a 10-year fixed rate, so not a 10-year fixed, but a 30-year loan fixed for 10 years, a 10-year ARM, what's called a 10-6 ARM. Interest rate, I just locked one in at, it was what, 2.625, 2.75. I mean, this is like a full 0.75% better than a 30-year fixed rate right now. So you're seeing such a tremendous reduction. So refinancing is still alive. Buying that home with a low interest rate is still alive. The average time frame a customer stays in a mortgage, I think, is somewhere around 5 years. I think I saw some study was like you're in a home for anywhere from 6 to 8 years now. Maybe that's changed now with the new environment we're in. But the good news is, if you know you're going to be in there 10 years or less, I'd say even 12 years or less, take the savings of a 10-1 ARM. Don't pay for that extra security when you're not going to need it. Take that 7-year, take that 10-year. If you're in the military and you know you're only going to be there 3 or 4 years and then you're going to PCS somewhere else, take the VA 5-1 ARM. They have the best ARM on the planet, and it's at interest rates tremendously lower than the 30-year fixed rates. So I hope this was helpful. If you have any questions, comments, do leave me a detailed comment in the comments below. Boy, I said comments quite a bit. But yeah, leave me a comment. And don't forget to leave me a like. It helps me out a lot. And we'll see you on the next video.